America's exporters are in crisis since Trump's second wave of tariffs in 2025. Ports are slowing, farmers are stuck with unsold crops, and major companies are bleeding billions. The administration promised tariffs would make America rich again. But what if these policies are backfiring, pushing the U.S. into its own trade recession? Today, we'll break down the data the industries hit hardest and what this could mean for America's role in global trade. Within weeks of the rollout, nearly every export sector took a hit. Agriculture, manufacturing, technology, all shrinking. Retaliation came quickly. China, Europe, Canada, and Mexico slapped on counter tariffs, and the ripple effect spread fast. Factories slowed production, ports sat half empty. International buyers, once reliable customers of U.S. goods, started shifting to suppliers in Asia, Latin America, and Europe. And this isn't just a blip, it's systemic. America is still selling goods abroad, but at much lower volumes and thinner margins. The big question, which industries are paying the steepest price and one of the first and hardest hit industries? Construction. Construction in the U.S. relies heavily on imported materials, Canadian lumber, foreign steel, and aluminum. Tariffs on all three sent costs soaring almost overnight. Take modular housing. Prefabricated builders in states like Texas and Florida saw project costs explode by double digits in just a few months. Infrastructure projects, highways, bridges, even affordable housing units are suddenly stalling because budgets can't stretch far enough. Analysts put the contraction at 3.6%, 6%, but that number hides the reality. Projects shelved, firms laying off workers, and U.S. builders watching contracts shift to European and Asian competitors who can deliver materials more cheaply. But construction is just the start. The real shock became visible at America's ports. Since April, export traffic has collapsed. Portland is down by half, Tacoma nearly a third, Los Angeles nearly 20%. Even Savannah, Norfolk, and Seattle, gateways to Asia and Europe, saw double-digit drops. And remember, these aren't just statistics. Each percentage point means fewer shifts for dock workers, trucking companies losing contracts, and small businesses near the port struggling to survive. In Portland alone, one shipping firm closed operations after 40 years in business. And in Tacoma, longshoremen say hours have been cut so drastically, some are leaving the industry altogether. For port cities, tariffs feel less like policy and more like a slow-motion hurricane, and the sector sounding the loudest alarm. Across the Midwest and South, farmers call this a full-blown crisis. Soybeans, corn, beef, crops that usually flow to East Asia are piling up unsold. Storage silos are overflowing. Prices are sliding. One farmer in Iowa told reporters he's staring at mountains of unsold grain, unsure whether he can even afford storage before it spoils. Industry groups warned that agricultural output will shrink by 0.8% this year. That may sound small, but for communities already hit by floods, droughts, and pandemic recovery, it's devastating. It wipes out years of fragile progress. And here's the long-term danger. Once foreign buyers turn to Brazil for soybeans or Australia for beef, they may never come back to the U.S. market. In global trade, when you lose a buyer, someone else steps in permanently. But while farmers sink, another sector looks like it's booming until you look closer. Liquefied natural gas exports hit record highs in 2025. Sounds like a win, right? But dig deeper and the cracks appear. China, one of the world's biggest LG buyers, imposed a 15% tariff. U.S. shipments there collapsed. Cargoes were diverted to Europe, where lower tariffs made resale possible, but profits shrank. For 40 straight days, not a single U.S. LNG ship reached China, the longest dry spell in nearly 2 years. So, behind the headlines, exporters are losing access to one of the fastest-growing energy markets on Earth. And energy isn't alone. America's manufacturing sector is caught in the crossfire. Manufacturing tells a split story. Basic industries like steel and aluminum saw a short-term boost up about 2% because imports were replaced by U.S.-made goods. But advanced industries, aerospace, electronics, precision manufacturing are bleeding. Retaliation from China, Europe, and Canada pushed tariffs on some exports as high as 125%. Aircraft orders collapsed. Microchip exports dried up. For decades, U.S. manufacturers dominated these high V-value sectors. Now they're losing ground to rivals in Europe and Asia who face fewer barriers. Market share is shrinking, and it may not come back quickly. And no industry is feeling this harder than automakers. General Motors reported a $1.1 billion loss in just one quarter. Stellantis lost $2.7 billion in the first half of the year. Deliveries to U.S. buyers fell 25%. For automakers, tariffs hit twice, Imported materials got more expensive while export markets slammed shut. Smaller suppliers, many family-owned, couldn't adapt. Without the capital to shift supply chains, they watched foreign competitors grab their customers. It's the steepest quarterly decline for U.S. automakers in over a decade, and even America's crown jewel, its tech industry, isn't immune. American electronics firms are now paying up to 34% tariffs on Chinese imports. Giants like Apple can absorb some costs, but smaller firms can't. Exports for mid-sized suppliers are down 30 to 40%. Some warn they won't survive the year. Europe and Asia added retaliatory duties, shutting U.S. tech out of key markets. The sector that symbolized America's global edge now risks isolation. So, what does this add up to for the entire U.S. economy? Economists project U.S. GDP growth slowing by 0.5 percentage point in both 2025 and 2026. Long-term output could be 0.4% smaller, equal to $125 billion in lost productivity every year. Jobs are vanishing too. Payrolls may shrink by 500,000 by year-end with unemployment already ticking higher. Tariffs will generate $2.7 trillion over a decade. But slower growth and weaker tax bases could erase nearly $500 billion of that revenue. It's a short-term cash gain at the cost of long-term strength. And here's the bigger story. This isn't just about economics. It's about America's place in the world. Yes, steelmakers and a few basic industries gained, but those wins pale beside the losses in high-value exports and global supply chains. Trading partners from China to the EU are rewriting their supply chains, cutting the U.S. out. In some cases, they're not just bypassing America, but actively creating systems designed to replace it. That's more than a slowdown. It's a structural shift in global trade, and it's leaving the U.S. on the sidelines. The export crisis of 2025 shows how fast tariffs can ripple through an economy and a world system. America hoped tariffs would strengthen its economy. Instead, they risk isolating it. And the consequences don't stop here. The next front in this conflict may be global finance, where shifting capital flows could reshape U.S. power for decades. That's it for today. Thanks for watching. We're independent, so your support means everything. Like, comment, and check out the next video on screen. We'll see you there.